Hello everyone, this is PC here from Global Alpha Search. I'm coming back to you with the usual monthly portfolio update for October 2020, which just finished. It's been a pretty good month, so let's just get going. And as usual, let's move on to my little presentation I have for you here. All right, so the epigraph I've chosen for this month is bad news is good news for the markets. It's basically the kind of message that we want to hear for the equity markets to eventually start performing better. This is exactly what we got in October. We'll talk through that in details in just a little moment. But let's first just move on to our portfolio overview and how we performed this month. The S&P rallied as much as 8% in October, which was a great performance. Gold was down slightly less than 2%. Treasuries represented by TILT, so the long-term US Treasury ETF was down slightly over 6%. And that all aggregates to our synthetic internal benchmark being up as 1.8% on month. And our portfolio, meanwhile, was up 3.2%. So this month we outperformed our internal synthetic internal benchmark, which is our official benchmark, obviously, but we did worse than the S&P 500. This is obviously due to the fact that we were most of the month only 50-ish% allocated into equities. We added some equities in the last month of October. And I will talk to that in just a little while, but most of the month we were out there in the market with less allocation than a fully exposed portfolio, fully equity exposed portfolio would have. On a year-to-date basis, S&P is down 19%. Our synthetic benchmark is down 22%. And our portfolio is down 12.5%. So we still do manage to outperform quite nicely versus both our internal as well as external benchmark. And it just again, please do remember that S&P is not our benchmark because our portfolio is cycle adjusted, so the equity allocations change throughout the economic cycle. As of the end of the month, our equity allocation was 71%, so substantially above our 50% usual threshold for the boom phase of the economic cycle. And this mainly comes from the fact that in the last week of October, I have basically averaged down in two of the growth stocks, namely SWKS, which is Skyworks, and AMD. They have dropped quite a lot, both technically and fundamentally. They are trading at very attractive levels right now compared to the historical averages and compared to the growth they do still represent. Also, we bought Microsoft, which now represents roughly 13% of the portfolio. So it's actually our biggest holding right now. This is a tactical purchase, basically for a little bounce after the Microsoft has dropped as much as 20% after their results for the third quarter, where they reported slightly slower growth in the cloud business, and revenues at the end of the day were only a 1% miss, really. So the stock, in my view, just got punished a bit too much, and I think with the general markets being okay-ish in October, and as I expect going forward as well. For now, Microsoft might have a little bit of a bounce. So we are substantially overweight right now versus our synthetic benchmark. I plan to stay tactical in this respect, and I think at the end of November we will still be overweight, but maybe just not as much as we are right now. There's been no changes in our gold holdings as well as our long-term treasury holdings. I do want to see a definite sign in in terms of inflation cooling, and I will get that once Fed tells me this is actually the case. I think we're getting closer to that, but I don't think we're not there just yet, really. Outperformance in October and year to date, we pretty much talked through that already. The reasons are pretty much still similar, so there's not that much to get into here. I'll just move on. Major drivers and major things that I think we should be paying attention to. So in October, we finally saw improving inflation trends, meaning inflation cooling in many areas like the commodity area, the rent area, the real estate area first. Thing, and these are the most important parameters for the CPI to basically continue cooling, and we did saw it in quite a few readings that we saw over the month of October. Secondly, third quarter 2022 earnings did not confirm recession, and they were actually mostly surprising to the upside again. This obviously has to do with the fact that the expectations for the third quarter were lowered dramatically over the course of, let's say, the first and second quarter of this year. And it's not really that difficult to beat right now. But anyway, we did get that, and given the positioning and where the markets are and how oversold they are, and so on and so on, beating expectations is now actually a marginal positive driver for equities to grind higher. More and more macro data are confirming a slowdown, which puts less pressure on the Fed to continue their very aggressive hiking path, right? That's one thing. Secondly, should continue to lower yields, especially on the long end of the curve, and they should stop strengthening the dollar. And these are the major things that I think are absolutely necessary for the equity markets to continue grinding higher. With weaker dollar and lower yields, we will basically have a more favorable picture for equities in general. Most damage in October has been done actually to a pretty narrow number of stocks, which were the biggest mega caps. They are mostly trading at far more expensive levels than the average S&P, and they weigh a lot. It needs to be said that like 8 biggest caps weigh as much as 23% in terms of S&P market cap, and on the other hand, they are pretty much 80% more expensive in terms of 12-month forward PE versus the rest of the S&P right now. So now, over the course of October, especially in the last week or so, we saw a couple of those mega caps reporting. They were mostly being punished after the numbers. Numbers were so-so, but generally with a tendency that confirmed the slower growth, for instance, in terms of Alphabet, slower advertisement growth, in terms of Microsoft, slower cloud growth. And this was basically the reason why those mega caps got hit. But the rest of the market is already trading at very acceptable levels of like 13, 14 times 12-month forward PE. Most of those names have so far surprised to the upside. And this is basically some kind of moment in the markets when right now it's mostly the mega caps that might actually be underperforming, with the rest of the market might continue to do better, which was exactly the case over the last week and a half of October, where we had days where the Nasdaq was down, S&P was down less than Nasdaq, and Dow Jones was actually up. Recession is not confirmed. The Atlanta GDP Now model is currently showing plus 3% growth for the fourth quarter of 2020. Earnings recession has also not materialized just yet. The third quarter 2022 over third quarter 2021 estimated consensus EPS growth has now slowed to slightly less than 2%, but it's still a growth. It's not It's not recession, it's not a fall in the expected aggregate EPS, it's generally slower growth. So the earnings recession, as we would call it, is not the case just yet. And going forward, even for the fourth quarter and for next year, we should actually again see faster growth. These data are confirmed, and the source is Yardeni Research. As you know, I highly recommend Mr. Yardeni's work. It's very consistent and adds a lot of value, a lot of very good statistical data. The first signs of central banks slowing their projected short-term rates trajectories. We saw that from the Bank of Canada, which lately increased rates by less than the market was expecting, by 25 basis points. We saw ECB talking about their most of the job done in terms of stabilizing prices in the Eurozone, which naturally implies that their trajectory of hikes might not be just as aggressive as it was so far going forward. And in terms of the Fed, I think the market is also kind of starting to discount that the Fed is getting somewhere close to their terminal rate. And once they reach that, and the inflation data do continue to confirm slower inflation pressures, then that the Fed might just want to hold off for a couple of months and see whether their aggressive policy from the first half of this year has been successful or not. So we're actually, summing it all up, we're actually, in my view, reaching some kind of point where bad news is good news for the markets in terms of the general financial conditions being so tough right now in the market that they pose risks to some kind of crisis, and when the Fed and other central banks just continue to act as they did. So right now we want to see slower or weaker data, weaker inflation data, weaker consumer data, weaker business data for that to basically make the Fed think that they need to be less aggressive. And obviously this is naturally good for the market, because less aggressive Fed means usually lower yields, a weaker dollar, and equities being more bid in general. And it needs to be said also, and this was pretty clear, especially in the last 2 weeks of October, that each marginal negative inflation surprise that we got that was having less of a marginal negative impact on equities. And this also shows the some signs of positioning being pretty exhausted and at some kind of extremes to the downside, right? There's been a lot of short selling. There's been a lot of basically cash collection. There's been a lot of outflows from equities, especially in the emerging markets, and the markets are now generally very, very oversold. Quick overview of the Fed changes. You know what happened in September, so I won't stick to that. But in October, we saw the Fed funds terminal rate probabilities looking at 475 to 500 bips range in March 2023, and that's where the Fed peak is expected. There's not been that many important speeches, but anyway, markets still do expect, and they do price a 90% probability of the Fed moving towards 375 to 400 basis points range during the upcoming FOMC meeting on November 2nd. The yield curve compression generally continues. Please do remember that yield curve inversion is basically when the 10-year yield is lower than the Fed funds, not than the 2-year yield. Most of the media stick their attention towards the 10-year versus the 2-year spread, but in theory and from the very strict macroeconomic view, an inversion is when the Fed funds are higher than the 10-year, which means this is a situation when the Fed is deliberately making the price of money too expensive and is making the financial conditions too tight. And right now, the Fed is still trying to not overdo with their hikes and keep the Fed funds below the 10-year so that the yield curve does not actually invert. What we're seeing right now in the 10-year to 2-year spread is basically the market expecting that over the course of the next 18, 24 months, we might actually see a risk of recession. This yield is either flat or slightly inverted right now, but obviously it will be a matter of time for us to see whether the inversion of the 10-year to the 2-year actually shows a recession over the course of the next year or two. But again, what we're seeing now on the screen is a compression. So the Fed funds basically getting closer to the 10-year, but not going higher than the 10-year, which would be an inversion then, right? Inflation tendencies, not that much of a change versus last month. 7 out of 18 GOGs still showing improvement. This is the similar reading that we saw in September. So on one hand, it's not showing much of an improvement, but on the other hand, that's at least not showing that the inflation pressures just keep rising everywhere. And in terms of commodities, please do pay attention to the fact that most of the energy commodities either add less or even deduct from the CPI on a year-on-year basis. If you take a look at nat gas, for instance, or gasoline, the readings right now in October are better than in September. So they're actually falling on a month-on-month basis and not adding on a year-on-year basis, which is obviously something that is very good for the general CPI readings to continue falling. Forecasts and expectations, we're still in the boom phase, so not that much change here. These things don't change just month on month. Private payrolls are up 4.5% year on year. Industrial production is actually even better than in September on year-on-year terms, and the delta is still green above zero, which shows that the coincident indicators of our macro allocation model, which is the enhanced aggregate spread by Dr. Robert Daly, are still telling us that we are in the boom phase, and the cycle peak is still to be expected ahead of us. As of now, the model is showing that over the course of the next 9 months, there should be no cycle peak, and we should continue to stay in the boom phase, which is obviously a phase that is characterized by increased volatility, increased instability, and the tendency for black swans to appear. Our conclusions, we're still in the boom phase. I do expect the balance of risk tilting toward less hawkish Fed, as I have already mentioned, growing possibility of synchronized actions from major central banks in case of any further stress in financial markets from here. So all the above, if accompanied with further signs of inflation easing, should basically lower sovereign yields and put a bid, sorry, there's a mistake here, and put a bid to risk assets, which are at extremely depressed levels. and are to much extent pricing in a full-blown recession already in many areas. And this full-blown recession is just not the case yet. So there's kind of a growing possibility for positive upside, positive surprises in a situation when the Fed would start being at least less extremely hawkish than it is right now. Fourth quarter seasonality generally supports equities, and from the tactical point of view, I have already mentioned that we plan to stay overweight equities versus our cyclical adjusted benchmark into the year. And but as I said, this is kind of tactical, so we might just as well not be at 70% equity allocation in a month, but rather closer to 60. But on the other hand, we will rather not be much higher than we are right now, because these are just tactical shorter term plays that we do right now to kind of add a little bit of an alpha to the portfolio. An interesting point here to make, some data from JP Morgan showing how the S&P has performed over the course of the last 4 big recessions or drawdowns on the market. And one very interesting thing to note here is that in 5 out of 6 of those cases, the S&P has bottomed ahead of the trough in both the earnings and payrolls and the GDP itself. So right now we might just as well be in this kind of mid-cycle point where the S&P might already be pricing in for the earnings growth to kind of speed up a little bit in the fourth quarter and in 2020. Time will tell, obviously. Thank you very much. This is it for this month. If you consider copying me, please do remember that we're a long-term portfolio. So a suggested copying period is minimum 1 year, but obviously the longer the better. 5 to 10 year copy duration is possibly the most ideal one. Thank you very much for this month, and I'll hear you in a month. Cheers.